Now, a cover call involves selling a call option on a stock that you already own. And the goal of the cover call strategy is to generate income by collecting premiums from selling calls and options on our stocks and ETFs. Now, as an option seller, our goal is to sell a call that is going to expire worthless, and so that we can do this over and over again and collect additional income. Now, the biggest risk of our cover call strategy is something called assignment, or being called away. And that's if the underlying stock or ETF price rises above our strike at expiration. So here's a chart of Chevron. And so let's say, for argument's sake, I own Chevron. It is an underperforming asset compared to, let's say, whatever the stock market is doing, or maybe other energy stocks. And you can see it's been kind of in a range here between 150 and 160. So if I'm willing to sell Chevron, right, I'm willing to let it go and I don't have to worry about tax implications, what I could do is use the cover call strategy to help maximize my sell price, as long as I'm willing to accept that price. So let's go to cover calls for Chevron. And again, let's look at those 30 days. And what do we have? Well, we have a 150, we have a 155, and we have a 160. So the 150 at the low end of the range, the 150 right in the middle of our range, and the 160 at the upper end of the range. But let's use the one that's in the middle, the 155 call, where we're going to sell the 155 call. Again, think about this in terms of, price has to get above 155 for this to be called away from me. And if I'm right and it doesn't get called away from me, I'm still going to collect 1.7% over the next 30 days. Do I feel comfortable selling that stock at the upper end of the range, and a stock that I really don't want to own anymore? Yeah. Now, does that mean that that event is going to happen? No, maybe not, right? Looks like it's about a 1 in 3 chance. So this is a great way to use an option strategy that will help you increase your sell price.